start recording. Hello and welcome to MEPL Classes, everybody. You are doing CFA Level 1 and my name is Rishi Jain. We will be continuing with financial statement analysis. And today we will be continuing with LOS 21, which deals with financial analysis techniques. I hope everybody is ready. Today we are going to learn, after we have understood everything about financial statements that we have read in the previous classes. Today we will learn how will we interpret them and how will we analyze the data that we have received into making financial decisions. But before we start, if you are liking our videos, please like, comment, share and subscribe to our videos. It gives us a lot of motivations to keep bringing such videos to you. Thank you, and let me just show you once how can you get MEPL classes. How can you get access to all the future classes of MEPL? You need to simply go to meplclasses.com. I hope you can see this on the screen. On meplclasses.com, go to courses, and from there you can go to international courses. On the international courses page, you will need to select CFA, and from this you can see that you are getting two options. The first one is for mobile users, those who want to access the classes on their mobile applications, and the second one where the laptop is made, you can access this from your laptop. So you can select either the mobile version or the laptop version. And this is our brochure that we have created for you to understand what CFA is all about and whether or not it is the right course for you. Now that all that is done, let us get back to studying. So LOS 21, financial statement analysis, which deals with financial analysis techniques. Let's move forward. So as we do in every class, this deals with what the CFA Institutes wants you to know after we have learned this chapter. It might seem very small, but this is going to be one of the longest classes we have done till now. So we are going to do very quickly, but everything will be in detail. But remember that everything that we have already covered in previous LOS, all those points will be covered quickly. But you can just go back to the previous LOS classes to refer to those points. Now let us see what are the things that we are going to learn in financial analysis techniques. 20A. Describe tools and techniques that are used in financial analysis, including their uses and limitations. What are the tools that are used in financial analysis? Next, classify, calculate and interpret activity, liquidity, solvency, profitability and valuation ratios. I hope you all remember that we have already done liquidity and solvency ratios and we had touched upon profitability ratios. So these are the things that we have already covered. Next, we move to describe the relations among ratios and evaluate a company using ratio analysis. We will understand how will we use ratio analysis to interpret the financial statements of a company. Next, we move to demonstrate the application of dew-point analysis of return on equity and calculate and interpret the changes in its components. This is something that is new to you, but this is very simple and related to your ratio analysis. Then we'll move to calculate and interpret ratios using equity analysis and credit analysis. Then explain the requirements of segment reporting and calculate and interpret segment ratios. Segmentation is something that you're going to learn in this class. This is new. And finally, describe how ratio analysis and other techniques can be used to model and forecast earnings. So ultimately what we need to do is we need to make a financial decision. We need to analyze the company. For that we need to make forecasts about how we expect the company is going to perform in the future. So we will learn how can we use the ratio analysis to decide and make a decision interpretation of the future projections of the company's financial statements. So let us start. First and foremost, What are the tools and techniques used in financial statement analysis? We already know about ratio analysis and common size statements. What was ratio analysis? Ratio analysis, instead of looking at absolute figures, gives us relative figures, or it compares two different figures. So when we use ratio analysis, it helps us to look towards the numbers on a more holistic level, which helps us to compare it with different companies and the industry standards. So while using ratio analysis, for example, let us say I give you that the profit of a company is $1 million. Company A and company B. And I say profit of company A is $1 million. And profit of company B is $100 million. What will you think? Which company is doing better? Given just the absolute figures, we will obviously think that company B is a better company since it's able to earn so much more profit. But if we look at the revenue of the company, and I say that the revenue of company A is $2 million, whereas the revenue of company B is $10,000 million. Now, if we look at a ratio, which ratio will we look at? We will look at the net profit ratio or the profitability ratio. In this case, the profitability ratio of company A is 50%, whereas that of company B is only 1%. So now which company will you say is better? Can you say that company A is better? We still need more information to make our judgment. What information will we need now? We will see what business is the company operating. If the company is operating in, let us say, a trading business. Trading businesses are very low margin in general. Depends on what kind of product you are trading in. Let us consider a steel product. The company is dealing in steel. So the steel trading business has very low margins, and the industry standard is 1% net profit percentage. So now let us say industry standard is 1%. So company B is operating as per industry standards. So we can say that company B is a good company. It is not overperforming, but it is not underperforming the industry either. So it is a good company. It falls somewhere in the middle of the pack. But let us say that company A is operating in a service industry, and the industry standard is 70% net profit margin. Generally, most businesses do not have such a high net profit margin, but let us, just for the sake of understanding, consider that company A is operating in an industry which has very, very high net profit margins. If the industry standard is 70%, but company A is only able to generate 50% net profit, in that case, we will be able to say that company A is underperforming the industry. This information in itself should be enough to make a judgment. However, then we will need to see why is company A underperforming. We will make our decision after looking at its financial statements. We will then go into the details of what is company A doing to make it earn less profits. So these are financial ratios. One second. What is? Okay, sorry. Let's leave it at that. Then common sizing financial statements. What did we learn in common sizing financial statements? Whenever we use common size financial statements, we present each line item of the financial statement as a percentage. For example, in case of balance sheet, what we did, each line item was presented as a percentage of total asset or total equity and liability. We know that total assets equals to total liability plus equity. So we can present the each line item. So we will present current asset as a line item. So we'll say that current assets are 30% of the total asset and non-current asset are 70% of the total assets of the company. So that is how we were presenting it. And in case of an income statement, as a percent, all line items were presented as a percentage of total revenue. So we were presenting every line item as a percentage of total revenue. This is the vertical common size statements. I hope everybody remembers. We have already covered this in previous classes. These are vertical common size financial statements, balance sheet and profit and loss account. We also learned about the common size cash flow statement, but we are not going to discuss this in today's class. That was done in the previous class. After we have learned about these two, we will also be learning about graphical analysis and regression analysis. What are these two? So graphical analysis is presenting the data of the company over the period of time in the form of graphs. It can be bar graph, it can be stacked bar graphs, or it can be line charts. We will learn about those in brief. And finally, regression analysis. Regression analysis helps us to compare how two data points move in link to each other. So let us read what is written on this slide and then we will move forward. Financial analysis is a useful tool in evaluating a company's performance and trends. The primary source of data is the company's annual reports, financial statements and MD&A. We have already learned this in the first class, LO 16. We learned where do financial analysts gather their data. They gather it from the annual reports of the company, the financial statements of the company, and beyond that they go to MD&A. What was mentioned in the MD of Meta that we learned about? They mentioned average daily users, average monthly users. That was just an example of what kind of data might be presented in the management discussion and analysis section of any company. If it is a manufacturing, or let's say if it is a retail store, what they might mention is revenue per square foot. That is some data that might be present in the management discussion and analysis. It depends from industry to industry. Every industry has certain specific data which is relevant to that. For example, in case of pharmaceuticals company, what is relevant is the research and development and how many new SKUs did you develop during the year. That is something that is relevant for pharmaceutical companies, and we need to understand that every industry has different data points and different ratios which are more important to it, and that data might be present in the management discussion and analysis section of the annual report. Then we move on to an analyst must be capable of using a company's financial statements along with the other information such as economy, industry trends to make projections and reach vivid conclusions. So for example, if I know that the edtech market is booming and a lot of people are going to shift to edtech, then investing in edtech companies would make more sense. I will first when we look at the industry first and then we select the company, that is called a top down analysis. And instead, when we look at the company, we judge the company first and then we read about the industry. That is called a bottom up analysis. So what did I say? When we first inspect the industry and determine whether the industry is moving forward, and then we make a decision to invest in that industry, and after that we go on to select which company in that industry should we invest in. That is called a top down analysis, because we are moving from the top till the bottom. We selected the industry first and then we move to the company. Instead, conversely, when we go to company first, that is when we select a good company. We pick a good company depending on various ratio analysis techniques, graphical analysis, or any other method that we might be interested in. We select the company first, and then before investing, we determine where the industry of the company is heading, and then we make our investment in the company. That is called a bottom up analysis. There are several tools and techniques which may be used when evaluating a company's financial status. These tools and techniques can especially be used when reviewing a company's financial data over time. So what do we mean by over time? That means it facilitates comparison over a period of time. So time series, it is called time series analysis. We can compare last year's data to this year's data much better if we have these tools and techniques to our disposal. I hope everybody is clear with this. Okay, moving forward. Now we go to ratio analysis. Today we are going to learn a lot of ratios. I know we have already done some of the ratios, but we will go through them again before moving to new ratios that we are going to learn today. And today we will be solving a few sums for ratio analysis as well. Okay, first. So ratio analysis enables us to evaluate a company's past performance and assess its current financial position. What does this mean? So when we are given that the current profitability ratios, that is the, let's say the current net profit ratio of a company is 10%, and we know that the previous net profit percentage in the previous year was 25%. So we know there has been a significant decline. So what is this ratio analysis technique allowing us to do? It is allowing us to evaluate the past performance and assess the current financial situation, the current financial position of the company. Besides that, it provides insights that can be used to project a company's future results. So when we see the data of ratios over time, let's say instead of 2 years, we are talking about 10 years. So let us say we have 9 years of data, and we know that the gross profit percentage and net profit percentage. Gross profit percentage has been like this: 75%, 77%, 81%, 79%, 61%, 83%, 81%, 79%, and 80%. Whereas net profit percentage has been somewhere around 33%. So when we look at this data, when we are giving this data relating to the gross profit percentages and net profit percentages of the company, then what we can see is there's a trend. Except for year 5, which we can see is an outlier in this case, there must have been certain incident, something out of the ordinary might have happened in year 5. So when we do a ratio analysis and we see a very common pattern, and there's just 1 year which is an outlier, and there's some absolutely different data in that particular year, what we can do as an analyst is we can ignore that data and instead look at the data that is giving us a more trend. When we look at this data, we see that the net profit percentage has been somewhere around 75 to 80%, and the net profit has been in the range of 33 to 37, 38%. So we know the rough range of where the percentages are lying for the company. And once we compare it with the industry standards, what we can do is we can use this data to predict the future. We can say that the company's future profits, future gross profit percentages and future net profit percent is going to be somewhere around that value, unless and until there is something major that is happening. For example, COVID hit. That was a major event that shook every company and completely destroyed the financial statements of many companies. A lot of companies went bankrupt while others rose to the top during that period. Right. So there was something completely out of the ordinary that happened in 2020. So that is why we can remove those years from our data analysis. And right now, since we already know that the gross profit percentage and net profit percentage is going to be in a particular range, we can use it to predict the future. And once we estimate the net revenue of the next year, then we can also estimate the gross profit and net profit using the ratio analysis. So like I said, ratios can be used to project future earnings and cash flows. So right now we use gross profit percentage and net profit percentage. Instead, if we used cash flow from operations divided by revenue, cash flow to revenue ratio. I hope you remember what we learned yesterday. So if we use cash flow to revenue ratio, then what can we predict? We can predict the cash flow of the company for future. We can evaluate a firm's flexibility. What does this mean? There are many ratios that we are going to learn about today, such as the liquidity ratios, solvency ratios, and activity ratios. Using those, we can understand how much flexible the company is. When we are doing those specific ratios which deal with flexibility, we'll be discussing it. So right now, we can just understand that ratios help us to determine the firm's flexibility. Assess the management's performance. Again, management's performance, how will we assess? We will do it in comparison with other companies, that is the industry. We will compare the management's ratios, that the company is generating, and we will compare it to the industry. If the manager is doing better than industry standards, then we will be able to say that the manager is above par or he is overachieving. However, if the manager's ratios that he's able to generate for the company is below the industry standards, then we will be able to say that the manager is underperforming. And for either case, we need to look into the details of why that overperformance or underperformance is taking place to make any final judgment. Then we go on to it helps to evaluate the changes in the firm and industry over time. This is just a time series analysis. We learned about time series analysis helps us to compare the ratios over a period of time. So this is a time series analysis. Since we are looking at the same company over a period of time, the gross profit percentage and net profit percentage that I have given for 9 years. So I have given that for 9 years. That means we are comparing this data for the same company over a long period of time. So this is time series analysis. Okay. And finally, we can compare the firm with industry competitors. Again, it is the same point, but this is known as, what is this known as? I've already told you in previous classes. I hope everybody remembers. This is known as cross-sectional analysis. So we'll compare the data of different companies in the same year. Make sure that we cannot compare different years and different companies. So if let's say we take 2021 Facebook and we compare it with 2019 Amazon, is it correct? Because in 2021 the impact of COVID has taken place. So there's a lot of changes in the industry. There's a lot of changes around the world. Whereas in 2019 things were much more normal, if we use that word. Things are much more normal. So we cannot compare 2 years and 2 companies. We can either compare different years for the same company, or we can compare same year but different companies. Different years, same companies, time series analysis, and different companies, same year is cross-sectional analysis. Next, we learn about the limitations. So ratio analysis again requires a lot of judgment. First point is judgment required. So what does that mean? That whenever we are looking at ratios, when we compare it to industry, there's a lot of judgment. So for example, like I said, in general, a high cash flow to operating profit ratio might be considered good. So we learned yesterday that CFO So what did we learn yesterday? That cash flow from operation activities divided by operating income. This is a ratio. And yesterday I mentioned that as an analyst, personally, I would like this ratio to be hover around 1. So what will I want? I will want that the company is generating cash flow in relation to its operating income. The cash flows is not too far deviating from its operating income. However, let's say that the operating profit, the cash flow from operations is 2 times, or the ratio is 2:1. In that case, some analysts might consider this to be very good and say that the company is able to generate a large amount of cash flows in comparison to its actual operating income. So this is a good thing for the company. Whereas others might think that this is not a good thing because it means that the company is underreporting its income. There's underreporting of income going on. I hope you can understand. Because the cash flows are high and the actual cash outflow is not taking place, what might that mean? That the management might be presenting fraudulent expenses to reduce its tax. What will this lead to? In the future, it might lead to tax lawsuits. The income tax department or the IRS for US companies, they might be on the vigilance. They might be waiting for the right opportunity to strike these companies. So I hope you can understand there is judgment involved. As an analyst, I might have a different judgment looking at a particular ratio, and some other analyst might make a different assessment. Next, accounting methods. We've already learned that both IFRS and the US GAAP allows various options to its users, and you are not compulsorily required to follow any one method. So different companies are following different methods, so the data might not be easily comparable. Certain analysts, what they do is they bring equilibrium. What they do is they take the data of both companies and then they convert the data into a common format, into following common accounting policies, and then they compare. But that is a very tedious and time consuming process. Next, when I was talking about comparing the ratios to industry standards, theoretically it's very easy to say, but in practicality sometimes it might become difficult to get industry standards. Let us say the company is a startup. So can we compare the data of a startup to a MNC? It does not look right. So what we need is the data of other startups, which might not be readily available because startups are generally not listed. So the data is not made public. And finally, inconsistent. What does that mean? That there are many interpretations that we can make looking at various ratios. However, when there are two ratios which should give the same outcome, it might be that both the ratios are giving different interpretation. Let us take for example, again gross, let's stick to our profitability ratio examples. Okay, so let us say that the gross profit percentage is 75%, operating profit percentage is 5%, and net profit percentage is 0.1%. So this is giving us mixed signals. It's very confusing to understand whether the company is good or not. So this will make our decision, our understanding very difficult, and we'll need to get into very much detail of the company's income statement to make our judgments. Okay, next let us move to common size statements. Even though we have already learned about common size statements a lot, we are going to just go through them again. And today, instead of just moving past common size statements, what we will do is we will look at a common size statement example, and then we will try to interpret what we can make this, what decisions we can make out of those. Okay, so common size analysis involves the creation of ratio between each financial statement item and a base item. So what does that mean? That we are presenting every line item as a percentage of a base item, which in case of income statement is what? The revenue. And in case of balance sheet, what did we take as the base item? The total asset. So we are presenting every line item of the financial statement as a percentage of the base item. This typically translates to total assets for balance sheet and total revenue for income statement. It is typical. Some people might take different options. For example, in case of income statement, some people, instead of using total revenue as the base item, they might take net revenue. Now both those items are different, and it might be case to case depending on what person is conducting the common size analysis. Again, this, when we are using the totals, this is called the vertical common size analysis. There's another thing called the horizontal common size analysis, where we take a base year value as the, we have not done any example of horizontal common size statement, so let us just do it quickly so that there is no confusion. I'm just giving an example of a horizontal common size analysis for balance sheets. Okay, so for doing horizontal common size analysis, it is very important to have more than 1 year's data, because 1 year's data will not give any information. Let us say 3 years. So when we give inventory, cash, long-term assets, and let us say deferred tax. So we have taken 4 items. For 2019, everything will marked as 1. So that means while we are comparing inventory, the 2019 value of inventory is 1. The 2019 value of cash will also be marked 1. So every item of 2019, which will be our base year, we are considering this to be our base year. So every value in the base year will be marked as 1. And then we go on to future years. We will compare the 2020 inventory to the 2019 inventory. Let us say in 2019 the inventory was $1 million, and in 2020 the inventory is $1.2 million. So what does that mean? That the inventory has risen by 20%. So what we will write here is 1.2. Let us say the cash decreased. So in 2019 the cash was 500,000. But the new cash balance has reduced from $500,000 to $400,000. So there has been a 20% decrease. So it will be reduced by 20%, or 1 minus 20% is 0.8. 0 0.8. 0 0 0 0 0 0 0 0 0 0 0 0 0 0 0 0 0 0 0 0 0 0 0 0 0 0 0 0 0 0 0 0 0 0 0 0 0 0 0 0 0 0 0 0 0 0 0 0 0 0 0 0 0 0 0 0 0 0 0 0 0 0 0 0 0 0 0 0 0 0 0 0 0 0 0 0 0 0 0 0 0 0 0 0 0 0 0 0 0 0 0 0 0 0 0 0 0 0 0 0 0 0 0 0 0 0 0 0 0 0 0 0 0 0 0 0 0 0 0 0 0 0 0 0 0 0 0 0 0 0 0 0 0 0 0 0 0 0 0 0 0 0 0 0 0 0 0 0 0 0 0 0 0 0 0 0 0 0 0 0 0 0 0 0 0 0 0 0 0 0 0 0 0 0 0 0 0 0 0 0 0 0 0 0 So the cash balance of 2020 is being compared to the cash balance of 2019. The inventory balance of 2020 is being compared to the inventory balance of 2019. So we are not comparing any different values of different items. Every line item is being compared to its own value in the preceding financial year or the base year. So let us say that the long-term assets increased by 3%, 30%, and the deferred tax reduced by 10%. Again, when we move to 2021, we won't compare it to 2020. We will again compare it to the base year. Every data is always presented as a comparison to the base year. So again, our base year is 2019. So let us say inventory from 1 million, 1.2 million, and now it has gone down this time to $700,000. So if it is $700,000, it will be 700,000 divided by 1 million, which is this. Let us say that the cash went up to 1 million from $500,000. So it will become 2. So 1 million is 200%, right? It has doubled. So that will make this value equals to 2. Let us say the and long-term assets. Let us just write. I hope horizontal common size statements are also very clear. This is relevant for doing time series analysis and understand how the various line items are increasing over time, increasing or decreasing. So horizontal common size analysis can highlight structural changes that have occurred in a company over time. So it is a time series analysis, an analysis of past trends that can help to develop future expectations. So if we see that the cash flow is increasing year by year, in year 1 it is 1.1, in year 2 is 1.2, in year 3 is 1.3. So we can predict that we expect in year 4 it will be 1.4. That is something that we can predict. Next, vertical common size analysis highlights the composition of the balance sheet and helps to answer questions such as what is the mix of assets and liabilities. So we will know what is the percentage of current assets as a percentage of the total assets of the company. So it helps us to determine what is the mix of total assets and total liabilities. And in case of income statement, it will help us to determine what are the various expenses in relation to the revenue of the company. When we present net profit as a percentage of the revenue, it is nothing but the net profit ratio. So if we prepare the common size income statement, it will help us to get gross profit ratio, operating profit ratio, and net profit ratio. We do not have to calculate these separately because these are already calculated in the common size income statement of the company. Okay, next we go to cross-sectional analysis or relative analysis. Compares metrics of one company with same metrics for another company in the same year, minded. This allows comparisons to be made irrespective of whether or not the companies are of significantly different sizes and report financial data in different currencies. So when we are using common size statement, what is the best thing? That everything is presented as a percent. So even if it is the company's total assets is $100 million or $1 million, it does not matter. Everything will be presented as a percentage. So it will help us to facilitate comparison between the two companies irrespective of the sizes. So the main benefit of common size statements is to facilitate comparison between companies of vastly different sizes. Now this is an example of common size balance sheet. What kind of common size statement is this? Vertical or horizontal? This is a vertical analysis. I hope everybody is clear with this, because it is a vertical analysis because every line item has been presented as a percentage of the total assets. So if you look at the total assets line, you will see 100% is written there because that has been considered as the base for every line item. So what do we interpret? In year 2018, cash and cash equivalent was 7.10% of the total assets, and it has kept on reducing. So the company's cash balance is reducing as a percentage of the total assets. So since it is reducing, we will just take a quick look at what is increasing in its place. So in year 1 to year 2, we can see that cash has reduced by 2% and correspondingly short-term investments has increased by 3%. So is this a good sign or bad sign? This is something that is neutral. So what the company is doing, the company is becoming more intelligent and they're using their idle cash to earn investment income. They're using their idle cash that is kept in the company to earn temporary investment income. So they're investing their idle cash. Next, we'll see that the receivables has gone down as a percentage. Is that a positive or negative sign? A reduction in receivables might mean two things: that the company is making more cash sales instead of credit sales, or the company's collection policy from debtors has become more stringent or strict, or the company has improved its debtor management policy. These are some of the some of the interpretations that we can make. And once we make these, when we think about these interpretations, then we can look at other ratios to determine. For example, we can look at the cash is to credit sales ratio to determine whether that is the reason for decrease in debtors. Next, let's move to inventory. We see that the inventory is roughly the same from 1.1%, 1.3%, and then to 0.7%. Again, while evaluating inventory also, since it is roughly the same, we won't be able to say much, but what we will be able to determine is that the company's inventory policy is roughly the same over the years. Moving on to long-term assets. When we see long-term investments, the company has a significant portion of its total assets in long-term investments. Mind it, in long-term investments might mean its investment in subsidiaries, or it might mean investment into non-operating activities. So if the company's a significant portion of the company's total asset is invested into non-operating activities, what will that tell us about the company? That the company is not the company is not expecting its operations to increase in the future. Instead, the company is more interested in earning investment income. So this might not be the right kind of company to invest in, but on the other hand, if the company has invested this money into its subsidiary company, then it is a different case. That means that the company is operating its business through its subsidiary company. And again, the long-term investments has increased over the years. So the investments of the company is paying off. This is what it looks like when we look at the common size statements. However, when we look at the absolute values, we can see here, when we look at this, that the value has decreased from year to year 3. Why has that happened? Because the total value of assets, the total assets has significantly reduced from year 2 to year 3. Again, why has that happened? Why has there been a fall in total assets? So when we look at why has there been a fall in total assets, we can see two major things. One is there's a new goodwill component. What does that mean? Since it is a accounting goodwill, that means that the company has acquired some company, because accounting goodwill is only allowed to be recorded when there's some acquisition taking place. And since the acquisition is taking place, where will the acquisition be recorded? New acquisitions are recorded under long-term investments. Now, since there has been a new acquisition from year 2 to year 3, yet there is a fall in investments. That means the company might have sold its old investment, and after selling the old investments, then the company might have purchased some new investment, which would have resulted in the formation of goodwill for the company. Right? So during that sale, what might the company have done? The company might have incurred a loss on the sale of those on the sale of the previous investment, or the company might have distributed the profits that have resulted in from the sale of the previous investment. This is what we can interpret from looking at this balance sheet. And finally, we also see that other assets are falling down significantly. There's a significant fall in other assets. Again, before interpreting anything from fall in other assets, we need to look at the components of other assets. For that, we need to look into the notes of accounts of the balance sheet. Now let us get into the liabilities section. In the liabilities section, again we can similarly interpret there's a increasing trend in in accounts payables. There's a initial fall and then there's a rise. So again, it might be several. It might mean several things. It can mean that the company is getting more liberal terms from its creditors. The creditors are allowing to defer the credit, or instead the company might be purchasing more goods on credit. Similarly, we can interpret a lot of things from every line item. Let us just take a look at long-term liabilities. That is more important, long-term liability and equity, and then we move forward. So when we look at long-term liability, we see that there's a significant fall from year 1, 2 and year 3. Year 1, 2 is roughly the same. So it might mean that in year 1, year 2, there's just an addition of interest. The company has not repaid its interest, so the interest component has been added to the year's 1's value of total debt. However, there has been a significant fall in year 3. What does this mean? When the company sold off its investments, the company might have used that sale proceeds to pay off its debt. That is why the value of balance sheet is going down, because the company has paid off its debt. So that is a positive sign, because the company is repaying its debt obligation, and in the future the interest expenses will be reduced. I hope that is clear to everybody. Similarly, other liabilities, the company has also paid off its other liabilities. And when we move to common stocks, there has also been a reacquisition of shares. So the common stock value is falling down. This means that the proceeds from the sale of investments has also been utilized to reacquire stocks. The company is repaying its equity shareholders also. Now this might have a positive or negative sign. If a company is reacquiring its stock from the open market, this might mean that the management believes that the value of the shares of the company in the open market is undervalued, and the management values its shares more than the value in which it is trading at. So it might send a positive signal. Or instead it might send a negative signal, in the sense that the company has excess cash with which the management does not know what to do. The management is clueless about what it should do with the excess cash that is in its hands. That is why what they are doing is they are reacquiring the stock that is trading in the open market. So there are multiple interpretations that we can make from this common size statement. I hope every analysis that I made from this balance sheet is clear, and there are various interpretations that we need to understand, and which can only be understood in detail when we take a look at these common size statements in conjunction with the ratio analysis and with management discussion and analysis and every other data available to us from the annual report. When we move to common size income statements, in common size income statements, we are taking, this is again a vertical common size statement. I hope everyone can understand what is a horizontal common size statement, which we already did just now. Now these two examples which is given here, these are vertical common size statements, right? In a vertical common size income statement, we take net sales or revenue. We take the revenue as 100% value, right? And we present every line item as a percentage of the revenue of the company. So now when we look at the cost of sales is the expenses that are directly attributable to the sale of the product or service of the company. We can see how the value of this cost of sales is changing. We can see that it is roughly remaining the same. So the company is consistent in purchase of its goods or services. There is certain consistency that is involved in the cost of sales of the company. When we move to gross margin, this is nothing but the gross profit divided by revenue. So this is nothing but a profitability ratio that we are going to learn about in the future in today's class. It is a profitability ratio. So when we present a common size vertical income statement, In that case, we do not have to present gross profit to revenue or gross profit ratio, operating profit to operate revenue, that is operating margin ratio, and net profit or net income to revenue, that is the net profit ratio. When we are presenting the vertical common size income statement, then these three ratios are directly given to us and we do not need to calculate them separately. So now in this income statement, this particular income statement, everything is very consistent. So what we see is that the gross profit has remained consistent over the years, the operating expenses has remained consistent over the years, and even the operating percentages and net profit percentages have remained consistent. So what does this tell us? That the company might be mature in its operations, which has allowed the company to maintain consistency. However, let me add an additional year with a major differences so that we can interpret certain things. So now we move from 16, 17, 18. Now let's move to 2019. 100% revenue. Let us say the cost of sales is now 50%. So the gross profit will become 50%. The R&D will become 15%. Selling and distribution 5%. 30% is remaining. So total is 20%. Operating income will become 38 minus 27. So this is 50 minus 20 is 30%. Then other income, let us say, is 5%. So it becomes 35. Provision for taxes is 10% and net income is 25%. So when we are given these values in 2019, so now what can we interpret? There has been a significant fall in cost of sales. What does this mean? It can mean two things. What can it mean? It can mean that the company has improved. They are buying their products from on better terms. They are getting better discounts. What this might mean that the company's scale of operations might have increased. That is why the company is able to negotiate better terms from its suppliers. That is why the cost of sales has gone down. Alternatively, what it might mean is that the company might have started to buy from cheaper vendors, and the company might have reduced the quality of its products. So again, if we consider it the first, for example, that is the scale of operations has increased. That is why the company is able to negotiate better terms from its existing suppliers. That is a positive sign for the company. However, completely on the other hand, if we consider that the company has reduced its quality standards, that might mean the company might not be able to sustain its current levels of revenue for long, because when the quality falls, the customers will ultimately go. However, when we move to operating expenses and we move to research and development, what we see is that the research and development expenses has increased a lot, and the research and development expenses has increased to 15% of the revenue. What does this mean? That the company has invested additional money in the research and development expenses. This is a positive sign, because this might mean that the fall in cost of sales might be because of increased research and development, better research. So this means that the company has developed some product which has allowed it to reduce its expenses. I hope this point is clear. So this is a positive sign for the company, the increase in gross margin. However, the research and development cost has also gone up. The selling and distribution again has remained roughly similar to the preceding year, so the company has not put additional efforts into the selling expenses. Again, the increase in gross margin by 10% has been offset by the increase in R&D by 10%. So there has been no significant change in the operating income or the net income, which has roughly remained around the same levels. Right? Okay, so one more important thing that we need to see is provision for income taxes. We need to make sure that the percentage of provision for income taxes is as per the applicable tax laws in the country. If let us say that the company's tax law, the company operates in a country where the tax should be 35%. 35% of the total income, net income. But in this case, the taxes are roughly 20%, right? 20%. So the company might be operating in a regime where the taxes are 20% of the net income. But if let us say that the company operates in a country where the taxes should be 30%, but the company is consistently paying income taxes which are only 10% of the net income, which we can easily see from the common size statements. In that case, we can interpret that the company might be evading taxes, the company might be using dubious methods to evade taxes, or the company might be doing something illegal to evade its taxes. That is a negative sign. So that is also something that we can get from common size income statements. Then we move to graphs and regression analysis. Graphs, basically, when we look at data as numbers, it might not mean too much to us, but when we convert the data into charts, when we are looking at this line chart, it gives us the revenue and net income of Apple. So what we see is the revenue is growing exponentially and the net income is also growing, although not exponentially. So looking at this line chart, we can directly see that there is a positive trend in both revenue and profits. So this is helping us understand and interpret the numbers of Apple much more easily and much more faster. So numbers in it by themselves might not make that much sense to me or to everybody. Since we are going to become CFAs, we will be knowing the meaning of numbers and we will be able to interpret it. But to our clients, when we go to our clients, they might not be so well versed with numbers, but everybody understands diagrams and charts. So instead of a line chart, it might also be a bar chart. So the bar chart might be something like this. I've drawn this line because this is a stacked bar chart. Stacked bar chart is something you might have learned in previously. However, this basically means this total bar represents the revenue of the company and the upper segment represents only the profits of the company. So what we can see is that the revenue again is increasing every year and the profit is remaining a constant portion of the revenue. So this is something that we might learn from a stacked bar chart. There are different types of charts that are available to an analyst disposal, which might help in better understanding the numbers of a company. Okay, so regression analysis is something that you will be learning in quants. However, I'm just going to give a brief of regression analysis. This will be taught to you by Pankaj sir. So regression analysis helps us to identify relations between two variables. Always two variables, not more. So for example, we might compare the variables, let us say sales and GDP growth rate. We might compare our sales growth data to the GDP growth rate of the country. So that is some sort of regression analysis that we might run to predict what the future sales growth is going to be. I hope everybody can follow till now. This is something that you just need to keep in your mind, that graph analysis and regression analysis are also some options of analyzing the data of companies that is available at the disposal of the analyst. So let us take a quick 5-minute break before we move on to financial ratios. We'll restart by 11:10. I hope everybody is following what we have done till now. In case you have any queries relating to anything, you can feel free to contact me. In case you have taken our classes, my number will be shared with you. You can WhatsApp me or you can give me a call and we will discuss your queries. Now take a 5-minute break and I'll be back. Welcome back, everybody. I hope everybody is ready. Let us start again. So we have already discussed what are financial ratios, what are common size statements, what are graphs and regression analysis. We have learned the uses and limitations of ratios and common size analysis. Now let us get into ratios, and we will learn about a lot of ratios. So financial ratios can broadly be divided into 5 different types of ratios. One second. Yeah. So financial ratios can broadly be divided into 5 types of ratios. The first, activity ratios, then liquidity ratios, solvency ratios, profitability ratios, and finally valuation ratios. And we will be learning every single type of ratio. We have already done liquidity ratio and solvency ratios. Liquidity ratio tells us about the ability of the company to meet its short-term liabilities, its ability to meet its short-term liability obligations. These ratios reflect a company's position at a point in time. They therefore usually use ending balance sheet data rather than so liquidity ratios will be using ending data values rather than average values. Then we move to solvency ratios. Solvency ratios measure a company's ability to satisfy its long-term obligations. We have already learned about these two in previous classes. We have also discussed all of the liquidity and solvency ratios. However, we'll just briefly go over them again. They provide information relating to the relative amount of the debt of the company's capital structure. Moreover, they reveal the adequacy of the company's earnings and cash flow to cover interest and other fixed charges. So now, what are activity ratios, profitability ratios, and valuation ratios? Activity ratios are also known as asset utilization ratios or operating efficiency ratios. They measure the efficiency of a company's performance. Its daily tasks such as managing its various assets. What do they mean? The accounts receivable turnover ratio, the inventory turnover ratio. These all ratios are covered under activity ratios. We will understand every ratio in detail in the following slides. These ratios generally combine an income statement item and in the numerator and a balance sheet item in the denominator. So always you will see that there's an income statement item in the numerator and a balance sheet item in the denominator. Profitability ratios, as the name suggests, help us to determine the profitability of the company. We have already learned about these. The gross profit ratio, the net profit ratio, operating profit ratio, all these are examples of profitability ratios. Profitability ratios measure the company's ability to generate profits from its resources. There are two types of profitability ratios: return on sales probability ratios, such as gross profit ratio, net profit ratio, which express various values on the income statement as a percentage of revenue. And there's another type of profitability ratios which are return on assets. So in that also the top line will remain the profit, that is net profit or operating profit or something like that. In the denominator, instead of revenue, we will have either total assets, so that will be a return on total asset, or we will have total equity, that is the return on total equity. Those are also examples of profitability ratios which are telling us how much the profit is earned, how much profit the company can generate per rupee of asset that is invested in the company. And finally, we come to valuation ratios. These are very, very important. So this is one of the most important part. Whenever we are going to invest in a company as an investor, let us say I have become a financial statement analyst, I am a portfolio manager, and I'm going to invest in, let us say, Tata, or let us just take an international company. Let me show you. So let us take Amazon share price. So we can see that the Amazon is trading at $89. And what we can also look at is we can get the 5-year data of Amazon. So currently, let's just consider, keep it to the first year. So in this 1 year, the company's value has fallen by 50, almost 50%. Amazon was trading at a high. The high was almost $173. Over $173. The Amazon was trading at over $173, and during 1 year only, it fell to only $89. There has been a significant decline. The company's value has fallen by 50%. So now what will we look at? We will look at how much earnings the company is making in relation to the price of the company. So what kind of valuation ratio we can use? The PE ratio, which is probably the most famous valuation ratio. What does this mean? Price of the company divided by earnings per share. So PE ratio, this is the PE ratio of Amazon, so which is 82. What does this mean? That Amazon is only able to earn around $1. Amazon is earning $1 revenue per share, and around $1. So it might be 1.3, $1.4, somewhere around that. And against that, Amazon is priced at $89. So it is trading at an earnings multiple of 82. The earnings multiple of Amazon is 82, as we can see here. So the valuation ratios give us a multiple in which the company is trading, and valuation ratios are generally presented as times. So how will valuation ratios be presented? Let us say it's a PE ratio. So I will say that the company is trading at 82 times its earnings. That is an example of a valuation ratio of the company. I hope everybody is clear with the meaning of different types of financial ratios. We will be learning about the details of every type of ratio. This is just an overview of what can be the financial ratio be divided into. Now let us start. First, as activity ratios. What do activity ratios give us? They give the meaning of operational efficiency. They help us to determine the operational efficiency. Okay, so now let us start. Let us start with activity ratios. The first being receivables turnover ratio. What is the formula? So we will see that what we have done is we have given the formula in the first line, and then we have written the interpretation of the ratio, right? So let us go through every single ratios. We are going to do a lot of ratios, and I hope everybody is up to the mark with every ratio. Please write down the formulas of every ratio multiple times in your copy so that you remember the formula of every ratio. This is very important and can come in your exams. Any ratio can come in your exam. So first, receivables turnover ratio. So it is revenue divided by average receivables. What is average receivables? Opening trade receivables plus closing trade receivables so opening trade receivable plus closing trade receivable whole divided by 2. So this is the formula for average trade receivables. Whenever we are using any balance sheet item as a in our ratios, whenever using any balance sheet item, be it trade receivable, trade payable, equity, total assets, generally we will be using the average figure. Why is that? Because balance sheet is a figure. Balance sheet gives us data at a particular point of time, and there might be significant changes in the values over a period of time, right? So just to make sure that we are using appropriate figures, what we do is we get the average of opening and closing, which gives us a rough figure which was existing during the year. So what does this give us? When we do total revenue or credit revenue, depending on which company. Revenue divided by average receivable. What do we mean? This refers to whether or not the company is able to collect money from its debtors. If the average receivables is low in comparison to the revenue of the company, this means that the company is making high revenue and the collection of money is also taking place. That means the company's earning quality is very high. A higher receivable turnover ratio it indicates that the company's earnings quality is very high and the companies convert its receivables into cash quickly. So let's read what's written. This measures the efficiency of a company's credit and collection policy. A relatively high receivables ratio may indicate that the company has high and efficient credit and collections. Okay, so again, every ratio can have multiple interpretations. One, it can mean that the company has company has a very highly efficient credit and collection policy, or instead it can mean that the company does not sell on credit. The company is forcing its customers to pay in cash. It has a very stringent credit policy. What will happen if the company has stringent credit policies? This would mean that the company will not be able to make more sales. Many people who will want to buy on credit will not come to our company, but instead will go to our competitors. So these are multiple interpretations. There are multiple interpretations. You might interpret something else also, and I would love to know what you are thinking, what you are going to interpret looking at this ratio. So now in every receivables ratio, we are going to do one more thing: days outstanding. What we are going to use? Days outstanding. What does this mean? We will do 365 number of days in a period. We are considering we'll be doing accounting for 1 year, right? So days outstanding divided by receivables turnover ratio. So let us do an example. Let us say that the revenue is $1 million. And average trade receivables, let's say $200,000. What does this give us? Receivables turnover ratio. 1 million divided by 200,000. 1 million divided by 200,000, right? Equals to 5 times. Now, is this a good figure or bad figure? Good. We cannot tell this without comparing it with the industry standards. If this is a company which is involved in retail sale, it will be a very bad figure, because in retail sale there is very low credit. The credit should be very low, so the value should be hundreds of times. The receivable turnover ratio should be hundreds of times. So it depends on which industry the company is operating in to make any judgment. But since we do not have the industry figures, we should just look at receivable turnover ratio. So that is revenue by average trade receivable. Now if we do average days sales outstanding equals to 365 divided by 5 equals to 73. The figure in this will be in days. So 73 days. What does this mean? What does this 73 days mean? This means that the company can, on an average, collecting its money from the debtors in 73 days. This measures the time that elapses between the sale and cash collection, the time that the company is giving to its debtors to collect money from them. So on an average 2.5 months, the company is collecting money from its debtors within 2.5 months if the receivable turnover ratio is 5. It reflects how fast a company can collect cash from its customers to whom it extends its credit. A low day sales outstanding indicates that the company is efficient in its credit and collection policy. The lower the day sales outstanding, the better the cash collection policy of the company is. Again, it can also mean that it's very stringent and it is not providing proper credit terms to its customers. So again, it can have multiple interpretations. Next, let's move on to inventory turnover ratio. Now, in any turnover ratio, the top line item will be an income statement item and the bottom line item will be the item which is in the ratio. So for the receivable turnover ratio, the top line item will be turnover and the bottom line will be receivables. For inventory turnover ratio, the top line item will be cost of goods sold and the bottom line item will be inventory. For trade payable ratio, the top line item might be again revenue and the bottom line item might be payable. So it depends. Okay. Okay, so what does inventory turnover ratio mean? The inventory turnover ratio means how fast the company can get rid of its inventory. That is how fast the company can make sales. So let's see, let us say I am purchasing inventory. I am purchasing 100 goods today. In how much time can I sell all those 100 goods? That is what the inventory turnover ratio is telling us. It tells us the effectiveness of the inventory management. If the company is having too much inventory in its books of accounts, what does that mean? That the inventory turnover ratio will be very low. And what will it mean? It will mean that the company is requiring to maintain a very high working capital requirement. The company has a very high working capital requirement. The company is not being able to sell its inventory on time. Alternatively, there's one more interpretation. If the inventory turnover ratio is very high, what does that mean? That the company is maintaining too low an inventory. If the company is maintaining very low inventory, that means that some customers might come to the company to look for products, but the company does not have them on their hand and they are not being able to sell those. So the immediate sale for certain retail customers who are coming to our shop, they might not find the inventory on hand since we are maintaining very low inventory levels. So again, this also has a dual interpretation. Low inventory turnover might mean that the company has very high inventory in its books of accounts, and very high inventory turnover might mean that the company is good with its inventory management, or it might mean that the company is maintaining very low inventory. Then days of inventory on hand, again this is number of days in period, that is it might be 365 divided by inventory turnover ratio. 365 divided by inventory turnover ratio. Again, this also, what does this tell us? How long the inventory is sitting in our factory or our warehouse before it is being sold to the customers. So if the inventory turnover ratio is, let's say, 5, and we divide 365 by 5, that means 73. So it means that the inventory is sitting in our factory for 73 days before any customer buys the inventory from us. We want this number to be very low, to be as low as possible, however not so low which would mean that we are maintaining low inventory levels and we are losing out on making any sales. I hope these two are clear to us: receivables turnover ratio and inventory turnover ratio, along with days sales outstanding and days of inventory on hand. Every term is very self-explanatory and I don't think anyone will be having any difficulties with these. So again, we have done 365 days here. However, in the formula it's written number of days in a period. Why is this? Because in case the value of revenue that is in the formula, in this case we are using cost of goods sold, and in this case we are using revenue. If the revenue figure or the cost of goods sold figure relate to, let's say, 1 quarter, if the revenue figure and cost of goods sold figure relate to 1 quarter, then instead of 365 days we will be using 90 days or 1 quarter. That is why it's written number of days in a period. I hope that is clear. Next, let's move on to payable turnover ratio. So I want you all to, without looking at the formula, please think of the formula on yourself. It's very simple. It will be total purchases. Why do we have payable in our books of accounts? It is because we purchase certain things from our creditors. So total purchases divided by payables. So a income statement item divided by the name of the ratio. So income, what is it? The income statement item is purchases divided by what is the name of the ratio? Payables. So purchases divided by purchases divided by payables gives us the purchases turnover ratio, payables turnover ratio. Again, we need to take average trade payables. Also in inventory turnover ratio, we need average inventory, which is opening inventory plus closing inventory divided by 2. Similarly, in average trade payable ratio, it is opening trade payables plus closing trade payable divided by 2. So whenever there's a balance sheet item involved, remember that we will always take average. Not all, sorry, I'm not sorry, not always. In most cases, whenever there's a balance sheet item involved, in most cases we will be taking the average. So this tells us how much time are we taking before we pay our payables. The higher this is, the better it is. Why is this? A higher trade payable ratio would mean that we are paying our trade payables on. Again, this also has dual interpretations. A higher trade payable ratio means we are paying our payables on time and we do not have high liability in our books of accounts. However, a low trade payable ratio would indicate that our creditors are giving us more liberal options. Our trade traders are accepting more liberal options as they are saying that we can pay off later. Alternatively, a lower trade payable ratio might also mean that we do not have the ability to pay off our creditors on time. I hope everybody can understand this. So a high trade payable ratio means that we are paying our creditors on time, or alternatively it means that our trade creditors are not giving us any good terms for taking credit. Conversely, when the trade payable when the payables turnover ratio is very low, that means that we are paying very late. That means either we are getting very good terms from our creditors or we do not have the ability to make payment to our trade creditors. Okay, moving on to our working capital turnover ratio. What is working capital? What is working capital, everybody? We have already learned about working capital in our cash flow statement. So working capital is nothing but the current asset minus current liability. It is also called the net working capital. In working capital turnover ratio, what we are concerned with is the net working capital. So what we'll do is the current asset minus current liability, again average working capital. So revenue divided by average working capital. This will help us to understand how much revenue the company is able to generate and how many times is the company being able to use its working capital to generate revenue. It indicates the efficiency of the company's operations and how the company is able to generate revenue from the maintained working capital in the company. A high working capital turnover ratio indicates greater efficiency. That means even with low working capital, the company is able to generate large amounts of revenue. Moving to fixed assets turnover ratio, how many times is the company able to generate revenue? How many times its fixed assets? Let us say that this is more relevant for factories and manufacturing companies. If a company is involved in manufacturing business and has invested $1 million, I will want my company to generate revenues at least 1 to 1.2 times of my fixed assets invested, or I will want my turnover to be as high as possible to the fixed asset investment. Since a higher fixed assets turnover indicates better or more efficient utilization of the fixed assets. Now again, this is very industry specific. For example, in a retail industry, what are the fixed assets? If the shop is also taken on rent, the fixed assets might be something like a computer. the computer and the furniture of the shop, that is the only fixed asset, so it will be very low in value. So in case of retail shops, the fixed assets turnover ratio might be as high as 100 times. However, for manufacturing companies, it might only be 1 or 2 times. So we want a higher number, no doubt, but we cannot judge any company for having 1 or 100 fixed assets turnover ratio, and it will depend on the industry in which the company is operating in. However, this is very clear that we want a higher fixed assets turnover ratio, because it will mean that we are able to generate more revenue per rupee of fixed assets that we own. And similarly, total asset turnover ratio, this is similar to fixed assets turnover ratio. Instead of fixed assets, we will take the total assets. That is total revenue divided by average net fixed assets, or total revenue divided by average total assets. This is this again depends on which industry we are operating in, and is very similar to the fixed assets turnover ratio. Now we come to liquidity ratios and solvency ratios. Since we have already done all these ratios, we'll be quickly just reading it out, and we won't be discussing this because we have already discussed every liquidity and solvency ratios in the previous LOS. So what do the liquidity ratios tell us? This tells us the ability of the company to meet its short-term obligations. How do we know that? We know if the current assets are greater than current liabilities. So if this is greater than 1, this means that the current assets are greater than current liabilities, and that means that the company can meet its short-term liability requirements. Okay. A less than one current asset to current liability will tell us that the net working capital is negative. If current ratio is less than 1, this implies net working capital is less than 0, or the net working capital is negative. How do we know that? If this ratio is less than 1, this means that the current liabilities are higher than current assets. And what is net working capital? Nothing but current asset minus current liability. So if the current liability is higher than current asset, that would automatically mean that the net working capital is negative. So this is something that you might just keep in mind, because this is a question that has come in the exam previously. So a high current ratio indicates that the higher level of liquidity, and that the company will be able to meet its short-term obligations, and short-term liquidity is not a problem for the company. As we move forward in the liquidity ratios, we will get more and more strict with our interpretation of liquidity. For quick ratios, what we do is we remove inventory and other current assets which are not that liquid. So we will only consider cash, short-term marketable investments, and receivables, which are considered to be more liquid. So this is considered to be quick ratio. What was the other name? We have already learned acid test ratio, correct? So this is the acid test ratio or the quick ratio. We want all liquidity ratios to be greater than 1. For current ratio, it might be 1.5 to 2 is a good value. For quick ratio, 1.2 to 1.3 might be a good value. And for cash ratio, 1 might be a good value. Again, it depends from industry to industry. For quick ratio, we will take the more liquid current assets and divide it by current liability. A higher quick ratio indicates a higher level of liquidity and the ability to meet short-term obligations. It is a better indicator of liquidity, since we are removing inventory and other slightly non-liquid current assets. Finally, cash ratio. This is the most strict liquidity ratio, since we are only considering cash and short-term marketable investments in the top line, whereas current liabilities, the entire current liabilities, continue to be the bottom line item. This is the most strict measure of liquidity and will help us determine whether the company will be able to meet its short-term obligations. Then these two are new items. These two we'll discuss. The first is the defense interval ratio. What is the defense interval ratio? It is very similar to the quick ratio, because this line item of the top line item is the same as the quick ratio. So defense interval ratio will have the same top line item as the quick ratio, that is cash plus short-term marketable investments plus receivables. However, in the denominator, instead of current liabilities, we are having daily cash expenses. What does this mean? Let us say that the company is incurring daily expenses of $1 million. The company expenses $1 million daily. So we need at least $1 million in cash and cash equivalents on a daily basis to meet the daily expenditure requirements. So that is what we are determining from this. We want this ratio again to be as high as possible, because a high defense interval ratio will tell us that the company has enough cash and cash equivalents in its books of accounts along with receivables and short-term marketable securities so as to meet its daily expenditure requirements. It will tell us how long the company can sustain without earning a single rupee. How long a company can pay its daily expenditures without any additional cash inflow. If the company's cash inflow suddenly stops, how long the company can sustain without earning any additional cash flow. Then cash conversion cycle. What does this mean? How long is the company taking to convert its inventory into cash? So what will you do? We will take the ratios that we have already learned in the activity ratios. The days inventory is held on hand, that is the time that we are keeping the inventory on hand, plus the days it takes for the receivables to pay back to us, and we subtract the number of days we take to pay to our suppliers. So let us take an example. How do we sell our goods? Let us say we are a trading company. What is the step 1? Step 1. Buy goods from suppliers. Has any cash moved out from my hands yet? No cash. Step 2. Obtain inventory. Again, no cash. Step 3. Sell inventory. Step 4. Collect money from debtors. And step 5. Pay suppliers. So what are the times when cash is moving hands? How many days are we taking to get cash? So first we will take how many days are we taking to sell the inventory. That is the time the inventory is in our books of accounts. We will add the time taken to collect money from our debtors. However, we are not paying our suppliers as soon as we buy the inventory. So what we'll do is we'll subtract the time we take to sell our product to pay our suppliers. So let us say on day 1 I bought the goods. Okay? Day 1 I bought it. On day 30 I sold my inventory. So my the inventory turnover ratio will be, the days to sell my inventory will be 30 days. I paid my payables. I paid my suppliers on 40th day, on day 40. So I took 40 days to pay my suppliers. And then I collected money from my receivables on day 90. So it took me 50 days to collect money from my debtors. So what will be the cash conversion cycle? It will be days taken to sell the inventory, that is 30. Then it took me 50 days to collect money from my debtors, that is 30 plus 50 is 80. And finally I paid the money to my suppliers after 40 days, that will be minus 40. So the cash conversion cycle will be 40 days. We want the cash to be our money to be converted in back to us as soon as possible. So we want a lower cash conversion cycle. The time taken between cash paid to suppliers and cash collected from customers. A low number for cash conversion cycle means high liquidity and better operations for the company. I hope everybody can understand these two ratios that we did today that we have not done previously. Again, solvency ratios help us determine the ability of the company to meet its long-term obligations. We have discussed solvency ratios in detail in the previous LOS, so we'll be going through everything in very quickly. So first is the debt to asset ratio. This just tells us the amount of debt that is in the books of accounts of the company per rupee of total assets that is there in the company's financial statements or the balance sheet. Total assets that are financed with debt. So if the total debt ratio is 40%, we will know that the financial assets, 40% of the total assets have been bought using debt. We do not want a very high total debt ratio because that would mean higher long-term liabilities and higher obligations in the future, which would impact the company's ability to run its operations, because the management will have payment of its long-term obligations in its mind, and the company will not be able to plan its future properly. Again, total debt to capital ratio. This measures the percentage of debt in comparison to the total capital involved. How is this different from the debt to total asset ratio? This does not consider current liabilities. So what are we doing? Total debt divided by total debt plus total shareholders, or we can write total assets minus total assets or total liability and total liabilities and equity minus other current liabilities. Anything that is not a debt we'll subtract, right? So this is helping us to determine what is the percentage of debt in our total capital invested. Next we learn total debt to equity. This will help to understand the debt in comparison to the equity capital. Again, this can be 50-50. So the company might have 50% invested in debt and 50% invested in equity. So that then the ratio will be 100%. So this again depends on which industry the company is operating in, which will determine how much debt the company should have. In certain industries, having a high debt might be good, because that will say that the company is positive about its earning potential, and the company knows that they will be able to earn net profits higher than the interest obligations, and the percentage of net profit is going to be higher than the interest obligations. That is why the company is maintaining high net debt. Alternatively, it might also mean that the company is not able to run the company without incurring debt. High ratio means high risk. However, risk is equivalent to return. Without risk, there is no return. You need to take risk to earn returns. Every return is directly related to risk. We've also done the financial leverage ratios, which is average total assets divided by average total equity. This basically tells us how much assets, how much average total, what is the value of assets that the company has for each rupee of equity invested in the company. The higher the ratio, that means more leverage, that means more debt in the company. Because if what is total assets? Total asset is nothing but liability plus equity. So what we are doing is total liability plus total equity divided by total equity. So financial leverage ratio can also be written like this: liability plus equity divided by equity. So what will this give us? The excess of liability over the equity. So per rupee of asset invested in equity, we do not want this ratio to be very high. That will increase the financial risk of the company. Interest coverage ratio and fixed charge coverage ratio. We have done interest coverage ratio, but we have not done fixed charge coverage ratio, which is very similar to interest coverage ratio. So please remember, what is interest coverage ratio? We are determining whether or not the company has enough earnings to cover its interest obligations, to meet its interest obligations. So what we do here, we have written earnings before interest and tax or operating profit. Alternatively, we can start from the opposite, or net income plus interest plus taxes divided by interest. हाँ, I hope everybody is clear. So it basically tells us how much earnings the company is earning and whether or not the company will be able to meet its fixed interest obligations, because interest is something that we are paying to our lenders and we cannot defer it. We have to pay our interest. So at least the company should at least earn enough money so as to pay its interest, so as to pay its lenders. So this will help us determine whether the net income is sufficient to meet its interest obligations. The higher the ratio, the better it is. If the ratio is, let us say, 3 times, that means the company is earning income which is 3 times its interest. So the company is in a comfortable position and will be able to meet its interest obligations without any difficulties. Similarly, fixed charge coverage ratio takes it beyond interest and it considers all fixed expenses. For example, rent. Rent is a fixed expense for the company and the company will not be able to defer such expenses. So we consider the income or the profits of the company before all such fixed charges. So on the operating profit plus lease payments. So lease payments, basically we have written lease payments, but we mean any other fixed expenses. So EBIT or operating profit plus all fixed expenses divided by interest plus all fixed expenses. I hope this is clear with everybody. So what we are doing is we are taking every earning that the company has before considering any fixed expenses. Interest is also a fixed expense for the company. Rent is also a fixed expense for the company. And there might be any other fixed expenses which the company might not be able to defer. So what we'll do, we'll take the operating profits, we'll add back all sorts of fixed expenses that the company is earning, the company is incurring, and we'll divide it by the total of all fixed expenses. The fixed expenses will include rental expenses and it will also include interest expenses. However, please note that this is the formula that has been used in your curriculum, so lease payments has only been mentioned. The number of times the company's earnings that can cover its fixed expenses or interest and lease obligations. The higher this ratio, the better the solvency of the company. Now let us move to profitability ratios. Profitability ratios help us to determine how much profits is the company earning in relation to various line items. It can be the line items are different and we'll discuss everything. Okay, so gross profit margin is nothing but the gross profit divided by revenue. It tells us it gives us a presentation of gross profit as the revenue of the company. We saw this value already in the common size income statement. When we are presenting the common size income statement of a company, the gross profit ratio, the operating profit ratio, and the net profit ratio is already presented to us. So the gross profit ratio is nothing but the gross profit by revenue. Operating profit ratio is the operating profit by revenue, whereas the net profit ratio is the net profit by revenue. So all these three ratios are already calculated automatically when we present the common size financial statements or common size income statement of the company. It indicates the percentage of revenue that the company is available to cover the operating and other expenses. So while calculating gross profit, we only reduce the directly attributable expenses and we do not reduce any other operating expenses or any financing costs or those costs. So gross profit percentage tells us the percentage of revenue that is available to meet those costs. Again, operating profit margin or operating profit percentage, it indicates the improvements in the controlling of the operating costs of the company. A higher operating margin means that the company is able to earn high operating income in comparison to the revenue of the company. And finally, net profit margin gives us the net income of the company, how much dollar the company is making per unit of revenue that company is making. So if it is 20%, that means that the company is making 20 rupees per 100 rupee of revenue that the company is generating. Pre-tax margin is very similar. Instead of PAT, so net profit is basically profit after tax. Instead of taking PAT, it is taking PBT. it is similar to net profit ratio. It takes the profit before tax divided by the revenue. So the per rupee of profit before tax that the company generates before earning its per unit of its revenue. Now, why is this relevant? So when we are comparing companies belonging to different countries, let us say I'm comparing a company operating in US with a company operating in India. In that case, instead of net profit ratio, I might consider the pre-tax ratio because of the different tax structures operating in the different countries. So I cannot penalize a company for paying higher taxes when the tax structure in the country in which it is operating is high. So now all these four ratios have revenue as a top line item. Now let us move to assets. I'm sorry, the denominator was revenue in all these four. Now let us move to different assets as denominators, or balance sheet items, not necessarily assets, but balance sheet items in the denominator. So operating return on assets. So what is operating return on asset? So what we'll do is operating income, or EBIT again. EBIT divided by average total asset. Remember balance sheet item, so we'll do average. So it tells us how much operating income the company is making per rupee of total assets invested in the company. So this is very important for us, and I want to know that if the assets are high, the operating profit per rupee of asset invested should also be high. So take a look at solvency. When we were in solvency ratios, we were comparing the total debt to assets. But when we come to profitability, we always compare the profits that the company is earning in relation to the assets of the company. So that was operating income to total asset. Then we move to net income to total assets. This is very self-explanatory after we have done everything. So net income divided by average total assets. This mentions the returns that the company is earning per rupee of total assets that is invested in the company. Return on total capital. So how is return on total capital different? Again, we have already discussed this. This does not take into account other current assets or other non-current. So everything that is a capital. What does this mean? So what is total capital? Average total equity plus long-term borrowings. These are the items that will be considered to be a part of total capital of the company, right? So this is the capital that is invested in the company. Our creditors are not a form of capital that is invested in the company. Those are also our debtors, but those are not capital. So we will want to know the operating profit that the company is able to generate per rupee of capital that is invested in the company, or the average total capital. Short-term borrowings are also capital. Total equity. Equity involves both equity shareholders and preference shareholders. Both equity and preference shareholders. So that includes the these things form the total capital of the company. So we will want to know how much profit the company is generating per rupee of capital that is invested in the company. Then we come to equity. How much money the company is earning per rupee of equity that is invested in the company. So that is net income divided by average total equity. Only equity, including preferred equity, minority equity, and common equity. I hope you all understand the meanings of all these terms by now. So we will do net income divided by average total equity to give us the return on equity, which will tell us the revenue that the income that the company is able to generate per rupee of equity that is invested in the company. And finally, the return on common equity. It's very self-explanatory. However, one thing that we need to make sure, we are reducing the preferred dividends. So when we are considering return to common equity, we will remove preferred dividends. So what we will do, take Net income minus preferred dividends, which gives us what? Earnings available to equity shareholders. This is something that we also calculated while calculating basic earnings per share. I hope everybody remembers. So it is the same numerator that we calculated while calculating basic earnings per share. So we have the earnings available for common equity shareholders, and we divide it by average common equity in the company. Every balance sheet item that we have considered till now has been average. So we take the opening plus closing and we divide it by 2 to get our value. Let us take a 5-minute break and then we'll continue. So it's 12. We'll continue from 12:05. Welcome back everybody. So let us restart very quickly. So till now what we have learned about the different types of ratios. We learned about activity ratios, liquidity ratios, solvency ratios and profitability ratios. We will be learning about valuation ratios later in this chapter. But before that we need to learn about dew point analysis. What is dew point analysis? So Mr. So what happened was we will be disintegrating the return on equity into 3 or 5 parts. It will help us get a better understanding of why the return on equity of a company changes. So we will, instead of presenting return on equity directly as net income divided by equity, we'll be showing it as a component of 3. How will we do that? So dew point analysis is the technique that can be used to decompose return on equity into its constituent parts. The process involves the expression of the basic ratio as a product. We will present return on equity as a product of compound ratios. We'll use 3 ratios and multiply all these 3 to get return on equity. This is helpful how? Because it helps us to determine the reasons for changes in return on equity over time for a given company. It also helps us to demystify the differences of return on equity between different companies. So what will you do? First, we will take average. We will take the return on equity, that is net income divided by equity. We'll do multiply revenue divide by revenue. This will give us what? How we can write it? So net income by revenue multiplied by revenue by equity. So we know net income by revenue is nothing but what? The net profit ratio, and revenue by equity is nothing but what? Equity turnover ratio. Now we will take this further. So what do we have? Net income by revenue multiplied by revenue by total equity, and we'll multiply by assets and divided by assets. Once we have done this, what we will do is we will rearrange the items. So net income by revenue or sales. So net income by revenue, or same thing. So net income by revenue is the first thing, that is net profit margin. Second, instead of writing revenue by equity, we are writing revenue by assets. That will give us total asset turnover ratio or the asset turnover ratio, and we'll do total assets by equity, that is nothing but the financial leverage, the leverage ratio. Let's take a look again. So what were the 3 ratios that we are multiplying? The net profit ratio, we multiply the net profit ratio with the asset turnover ratio. This. So asset turnover ratio is nothing but revenue by total asset, and then finally we do total asset divided by total equity. Total asset by total equity. Financial leverage. This is financial leverage ratio. So total assets by total equity. By multiplying these 3 ratios, we can get ROE. So we do not need to get confused of what dew point analysis is. It is just decomposing ROE into 3 components. If you forget in the exam, just remember that we need to multiply and divide by 2 items. First, we multiply and divide by revenue, and second, we multiply and divide by assets, and then we just shuffle everything off. The first is net profit margin, second is the total asset turnover, and the third and final being the financial leverage ratio. Now we need to understand why is this relevant. So now when we are given the return on equity of a company, let us say the return on equity is 5% and next year it is 8%. So it is a significant increase, 3%. The return on equity has increased significantly. We will be able to tell whether the net profit margin has increased or whether we have increased our revenues, or whether we have increased the leverage in the company. So we will be able to tell why the equity is rising, why the return on equity is rising. Is the increase in equity a result of increase in the profits while the revenues remain the same, or the increase in ROA is due to the increase in turnover while the assets remain the same, or whether or not the increase in return on equity is because of increased financial leverage. If the ROA is increase in ROA is due to increase in leverage, then that will be that the company is taking higher risk. If the company is earning higher turnover per asset, that would mean improved efficiency of total assets, and better net profit margins might indicate that the company has increased its operational efficiency, or alternatively it might also mean that the company is reducing its quality. So we need to understand the reasons why the return on equity is increasing. Now we can further break this down. We can further break down net profit margin. We'll keep these two same. So asset turnover and financial leverage remains the same. Okay. But we will break down the net profit margin. So how can we instead write net profit margin? So net income divided by revenue multiplied by EBT divided by EBT multiplied by EBIT divided by EBIT. This is what we do. We multiply and divide by EBT and EBIT. Now again we shuffle everything. So net income ratio or net profit margin can also be written as net income by EBT, that is profit after tax divided by profit before tax. Simply net income is profit after tax, PAT by PBT. So PAT by PBT, what does this give us? How much is the tax burden? How much tax the company has to pay? Now EBT by EBIT. So earnings before tax divided by earnings before interest and tax. That is the interest component. How much interest the company has to pay. And finally EBIT by revenue. This is nothing but the operating profit. So what we are getting? We are first getting what is the operating profit margin, how much interest the company has to pay, and how much tax the company has to pay. So when we look at this ratio, tax burden multiplied by interest burden multiplied by EBIT margin multiplied by asset turnover and financial leverage, these two remain the same as the 3-point analysis of 2-point analysis. So in this we are breaking down net profit margin further, and when we look at this we will be able to determine whether the return on equity is increasing due to reduction in taxes, due to reduction in interest expense, or due to better operational income, or the balance two remain the same. I hope everybody understands what we did in 2-point analysis. And why is this important? Because this is helping us understand why are the changes taking place in the return on equity. We are very clear that changes are taking place, but this is helping us understand why are the changes taking place. Now let us move forward into equity analysis. So we said that in today's class we are going to understand how financial statement analysts utilize the various financial statement data. So let us understand what are the valuation steps. What are the steps to value a stock that a financial statement analyst might take? Number one, we need to understand the business and the existing financial profile of the company. We obviously have to know what business the company is operating in, because if the business is finance, let us say retail, then interpretation of the ratios will be completely different than if the company is, let's say, a manufacturing firm. So depending on which business it is, our interpretation of every ratio analysis will be very different. Next, we'll forecast the company's performance, such as revenue projections. How will we forecast? We might forecast using common statement analysis, using ratio analysis, using graphical representation, using regression analysis. Those might be the various methods we might use to forecast. Then we will select the appropriate valuation model. It might be FCFF, we might do various models such as discounted cash flow method, or we might use various ratios such as price to earnings ratio or price to sales ratio. Then we'll convert the forecast into a valuation, and finally we'll make the decision whether to invest in the company or not. Understand the business, forecast the future revenue, select the model, use the model to predict the future valuation, and then finally decide whether to purchase the company or not. These are certain items that are also considered by financial statement analysts. For example, for determining the ratios, we have already learned about EPS and the diluted earnings per share, and even cash flow per share we learned yesterday, right? We should remember that all these are values are important to understand how much money the company is generating per equity share. So if I'm going to buy an equity share of a particular company, I should understand how much earnings is the company generating per equity share that I'm holding. Let's move to valuation ratios. This is the final set of ratios. And in valuation ratios, the top line item will always be the price or the market price. For example, like in Amazon, we just saw that Amazon was trading around $89. So that $89, that is the current market price of the share, is the top line item or the price of the company. So that means that is the value that people are attaching to Amazon per equity share of Amazon. And we will determine what is the ratio of the price in comparison to various line items. So what is the first and foremost thing that we can compare the price to? Why will we pay the company? Why will we pay to buy the company? We will pay because we expect future economic benefits. Those future economic benefits basically mean the earnings that the company is earning. So we will compare the price of the company to the earnings per share of the company. So that is the price to earnings ratio. This is probably the most important valuation ratio. It tells us how much an investor in common stock pays per dollar of earnings. In Amazon, that was around 82. That is very, very high. Now, such high valuations are present generally in tech companies. Tech companies are trading at very high valuations. However, if you look at any other company, a very good understanding, mostly PE ratios should not be higher than 20. Like personally, when I am going to invest and I am investing my own money, I see that if a company has a PE ratio of lower than 20, if the company's PE ratio is higher than 20, then I will get more vigilant and I will be looking the financial statements with more detail. I hope you all can understand that I want the company to earn at least 1 by 20 times the price I am paying. Next, price to cash flow. Like we have learned about cash flow in the previous class. Cash flow is more important for companies which are presenting their statements in the wrong manner. For example, what might be happening is that the company might be showing very high net income and very high earnings per share, but actual cash realizations against those earnings might be very low. So that will mean poor earnings quality, and the actual cash flow might never be realized from that income, and the debtors might go bad. Bad debt might be realized at future dates. So what is a better option? We, along with P ratio, we should also look at PCF ratio. This cash flow per share is cash flow from operations. I hope this is clear to everybody. So we should also look at the price to cash flow ratio, because the company might be presenting its earnings much higher than it is. I will give you an example. There is a edtech company in India. I will not use its name. But what that company did is they were selling their courses over, let's say, 2 years. They were receiving the money on day one. Day one, they were receiving money from the clients. So we have already learned from the revenue recognition principle that we should defer the revenue over 2 years. But this company was not doing this. So the auditors issued a modified opinion. This is a very hot case and everybody was talking about it when this happened, because this led to fraudulent accounting practice. That is why along with PE ratios, we should also be looking at PCF ratios. But what if it is a very, very new company and the earnings are negative and the cash flow from operations is also negative? In that case, we cannot compare the PE or PCF ratios. That is when P sales come into the picture. We can compare the price to the sales of the company, the entire revenue. Revenue can obviously not be negative. So we will compare the sales of the company to the price. This will tell us what is the price per unit of sales when the company does not have positive net income. This is relevant, more relevant when the company does not have positive net income. And finally, we come to the final valuation ratio, that is price to book value. So what is book value? Book value per share is nothing but the total equity. This includes retained earnings and all other sort of reserves, divided by total number of shares. So that is the book value of shares. The book value of shares, and we compare it to the price of the shares. Again, if the book value of shares is, let's say, $10, we will want the price to be not higher than, let's say, $2 to $3. We do not want a very high book value, but again, that depends on industry to industry. This compares the stock's market value to its book value. It is often used as an indicator of market judgment about the relationship between the company's required rate of return and its actual rate of return. So the net income divided by the book value per share gives us the actual return, whereas net income divided by price gives us the required rate of return. Higher ratio implies that the investor expects management to create more value from the given set of assets. So these were the valuation ratios and how to calculate them. Next, we move to dividend. What are dividend? Dividend is the money that company pays to its equity shareholders. It is declared on a per common share basis. We do not consider preference dividends right now because preference dividend is compulsorily required to be paid. Now, total dividends of a firm-wide basis are referred to as dividend declared. Neither EPS nor net income is reduced by common stock dividends. So whenever we are calculating EPS or whenever we are calculating net income, we do not subtract dividends. So net income is inclusive of the dividend that has been declared. Net income minus dividend declared equals to retained earnings. That is the amount of profit that the company is reinvesting into the business of the company, that the company is again investing into the company to earn greater profits in the future. So the amount that is invested will be utilized in the operations of the next year, and that will help to earn greater profits in the next year, right? So now when we are going to predict the future growth rate of the company, how can we predict the growth rate of the company? The company will be growing using the retained earnings, because the dividend that had been declared and paid off to the equity shareholders, that amount will not be remaining with the company, and the company will not be able to use that money to invest into its business or earn extra money from the dividends. So when the retained earnings is multiplied by the return on equity, because retained earnings becomes nothing but the equity of the company. So the retained earnings, when it is multiplied by the return on equity, that is the value of the growth rate. That gives us the growth rate of the company. It is also called the sustainable growth rate. This formula is very important and will be relevant to you in all three levels of CFA. Okay, so the retention rate is equals to retention rate multiplied by return on equity. How do we calculate retention rate? How do we calculate retention rate? So that is the retained earnings divided by net income attributable to common shareholders. That means after deducting preference shares, right? So retained earnings divided by net income attributable to common shareholders. So that means we can break it down as net income minus dividend declared minus dividend declared divided by net income. So instead of writing retained income, we can simply write net income minus dividend declared, because that is the formula for retained earnings. So that is net income minus dividend declared divided by net income. That is the formula that's written here. And now if we use common algebra, so that is net income divided by net income becomes 1, and dividend declared divided by net income is nothing but the dividend payout ratio. So 1 minus the dividend payout ratio gives us the retention ratio, which has been written as B. So B is the retention ratio. I hope everybody is getting it. So 1 minus dividend payout ratio will give us the retention ratio, and retention ratio multiplied by the return on earnings will give us the sustainable growth rate of the company. Now, like we said that there are several ratios and we need to look at every ratio from an industry specific. There are certain ratios which are relevant for only certain industries. Ratios serve as indicators of some aspect of the company's performance and value. Aspect of performance that are important in one industry may be irrelevant in the other. So there are certain industry specific ratios, such as for service companies. Let us say for the MBB, that is management consultancy companies, they will want to see at the revenue they are generating per employee. So their employee cost is the highest. That is why they will be focused on revenue per employee that they are being able to generate. A hotel might be interested in average daily rate or occupancy rate. They will want their occupancy rate to be as close to 100%. They will want their rooms to be occupied throughout the year. But I believe that during season time, that occupancy rate is around 80 to 90%, and in non-season time the average occupancy is around 40%. So for hotel industry, the average occupancy throughout the year will come around 70% somewhere. And finally we go to retail industry. We will be considering the sales per square foot. So we want the maximum utilization for our floor space. Retail industries are considered about the retail customers and they want maximum sales to be made per square foot. So when we look at sales per square feet, do you think MBB or a service based company will be considered about sales per square foot? They do not care, because their entire service is being provided online. So they can provide entire services online. They do not care about the square foot of their office. So these are some examples of industry specific ratios. This might be different for every different company. Like in Meta, we learned average daily users. So the revenue per user might be relevant for Facebook. Revenue per app user. I'm just giving an example. Next, let's come to credit analysis. Credit analysis. What do you mean by credit analysis? There are certain ratios which will help us in credit analysis, which means that it will help us to understand the credibility of the company and whether the company will be able to meet its obligations. It is very similar to the interest coverage ratio that we have done earlier. So EBIT interest coverage ratio, EBITDA interest coverage ratio, FFO interest coverage ratio, and return on capital. These ratios will help us to understand the credibility of the company. These are not very important for the exam, and these have just been mentioned, and you should know that these ratios exist, but you will not be asked to calculate any of these ratios. Credit analysis is based on many of the ratios that we have already covered and helps us to determine the ability of the company to service or repay its debt. Okay, when you are reading the book, somewhere in some places they might mention a term like Altman Z-score. You will be learning about Altman Z-score in level 3, but right now I just let me mention that it considers various ratios and gives weightages to different ratios and will give us a final number. So Altman Z-score will just help us to determine, it takes the various ratios and gives them certain weightages to determine a final value of the Altman Z-score. That is not important for your exam. You just need to know that Altman Z-score is something that is used for credit analysis of a company. You do not need to know how to calculate the Altman Z-score for level 1. So these ratios are just for your reading. Now, this is this is the second last portion of this chapter, and this is important. So segment reporting. What is segment reporting? If the company has, let's say, various segments, like today have I opened the financial statements? Just hold on a second. Let me open the annual report of Meta, and then we will be seeing whether they have made a segment report. Okay, so Facebook has divided its operations, its entire business into two segments. The first being family of apps. This includes Facebook, WhatsApp, Instagram, etc. And the second being reality lab segment, where they deal with augmented and virtual reality segment. So this is a two segment of business for Facebook, and they are mandatorily required to present the revenue, costs, income of different segments separately. So how will we segregate? How do we know? How should we segregate the different business lines of a company? A company can have several business segments. So what is the criteria for determining whether or not to consider it a different business segment or not? So there are quantitative criteria that has been mentioned, which in the given case, this depends from this is given in IFRS or US GAAP, so it might differ from country to country again, depending on which standards you are following. If the segment constitute 10% of or more of the combined operating segments revenue, assets, or profit. So if, let's say, Reality Labs has more than 10% revenue or assets or profit of the company, in that case it needs to be presented as a separate segment in the company. However, if there are multiple segments which are, let's say, 2%, 3%, 4%, then they can be clubbed together. If they are forming only 2-3% of the total segments, of the total value of assets, revenue, or profits, then in that case these smaller segments can be clubbed together. Now it has been mentioned that if the combined segments that has been recorded presents less than 75% of the total company revenue, a company must identify additional reportable segments until 75% segment is reached. What does this mean? Let us say company A has 5 segments. Segment 1, 2, 3, 4, 5. So let us take a very simple example first. Let us say all segments are 20% in they present 20% of the revenue. So we will have to present every segment separately. That is what has been mentioned, because since every segment holds more than 10% of the revenue, that is why every segment needs to be presented separately. Now let us take a different example. Let's say this is 40%. This is 30%. This is 15%.
40, 30, 15, 7% and 8%. So this is how it's divided. So in this case, we need to separately present segments segments 1, 2, 3, and segments 4 and 5 can be clubbed together, and we do not need to present their data separately. So segments 4 and 5, it does not need to be recorded. I hope everybody understands this. So in the second case, segments 1, 2 and 3 have to be recorded separately and reported separately, where segments 4 and 5 do not need to be reported separately. Now let's take another example. Let's say this is 60%. This is 30%. Sorry. Let's say this is 9%, 9%, 9%. Let's say that 4, 5, 3, 4, 5 all are 9%, and 1 and 2 are 60%, and how much is left? 60 plus 13%. So in this case, 1 and 2 will have to be reported separately, right? So segments 1 and 2 have to be reported separately. So what is the total of 1 and 2? That comes to 73%. So this total revenue that has been reported separately is 73%. This is less than 75% of the total revenue. So in this case, the company will need to present an additional. In case the revenue that is being presented separately is less than 75%, then additional segments need to be identified till we reach 75%. So let us say we will also take 3. Now since it is going to more than 75%, we can club 4 and 5. I hope everybody understands. So as long as the segment in itself is more than 10%, then it is mandatorily required to present that separately. However, if the total segments that have been presented separately do not constitute 75% of the total revenue, then we need to identify additional segments till we reach 75%. I hope this is clear. Now small business segments may be merged into one, like we merged 4 and 5. And define business and geographical segments can be geographically or business wise. So it might be different lines of business, or it might be different geographical locations. It depends on the company how they are making different segments. Information on operating segments and businesses that are not reportable should be combined in all other segments category. Like we mentioned on the 4 and 5, they can be small, can be segment clubbed together. Companies must disclose the factors that were considered in the identification of reportable segments. Besides, they must reveal the type of products and services sold by each segment. I hope this part is also clear and you all understand that what is required to be presented. Now, this is just the disclosure requirements. And we need to just read through this. There's nothing to understand in this. So for each reportable segment that is having 10% more, we need to present separately their separate profit and loss, separate total asset, total liability, segment revenue, distinguishing between revenue to external customers and revenue from other segments. This means that the one segment might be selling to another segment, so we need to separately show whether it's selling to the company is selling to itself, or whether the segment is selling to external customers. We need to separately present the interest, revenue and expense, separate property, plant and equipment and intangible assets, separate depreciation, separate non-cash expense, separate income tax, and separate share of net profit. I hope everybody is clear. These are the disclosure requirements for segmentation analysis. Then a company must provide a reconciliation between the information on reportable segments and the consolidated financial statements in terms of segment revenue, profit or loss, or assets and liabilities. What does this mean? That we need to reconcile of segment and the total. So the summation of all segments should ultimately get to the total. And if there are any differences, then we need to reconcile that. Why will there be differences? For example, let us say in case of revenue, we said that one segment is selling to another segment, even though the segment will present it as a revenue in the segmental revenue, but in the total revenue of the company that will not be presented, because the company will only be showing its revenue of sales to external customers. The company will not be showing any sort of revenue that is being sold to internal customers, that is one segment selling to another segment. This is not a revenue for the entire company as a whole. So that is the difference that might arise. Companies must disclose if any single customer represent more than 10% of the company's total revenues. So for example, let us say there's a major company and one particular customer takes 20%, is giving 20% of the revenue. In that case, we need to separately disclose this. Now these are same as all the ratios that we have already learned. So profitability ratios, instead of the this is net profit ratio, we'll do segment profit divided by segment revenue. So this is nothing but the profitability ratio for the specific segment. Then segment revenue to segment asset, this is nothing but return on asset for that particular segment. Okay, sorry, this was segment, this is return on asset, and this is segment revenue to segment asset. So this is nothing but the asset turnover ratio. This is nothing but the asset turnover ratio for the particular segment. So instead of considering the entire company, we will calculate the asset turnover ratio for the one segment, and this is the return on asset for the segment. And finally, the segment debt ratio, that is segment liabilities to segment assets, in order to determine how much is the leverage of the particular segment, the level of liabilities of the segments, that is the solvency of that particular segment. I hope this is also clear to everybody. And finally, we are in the last segment of today's chapter, that is ratio analysis to forecast earnings. How will we use ratio analysis to forecast earnings? There are three techniques that has been mentioned: sensitivity analysis, scenario analysis, and simulation. So sensitivity analysis is nothing but what if analysis. We will say, what if this had happened instead of this? So we will say, what if the company had earned profitability or the profits of 10% instead of 12%? What will happen then? How will the financial statements look in such a case? And what if in the future the company's revenues increase by 10%? What if in future the profitability increases by 2%? That is a sensitivity analysis, in which we alter one thing. We alter just one thing to determine what will be the impact of one change into the entire financial statements of the company. Then scenario analysis is of moving forward beyond sensitivity analysis, because this shows the change in key financial quantities from changes in major economic events. So in sensitivity analysis, we were changing just one item. In scenario analysis, we are changing many things. So we are expecting what if a future economic event happens and this changes this line items. So we will change many line items, and we will try to establish the impact of the changes of those line items on the rest of the financial statements. For example, the company loses a major supplier. What will be the impact of losing that major supplier on the entire financial statements of the company? Or whatever natural disaster take place. For example, there is an earthquake in the country, in the city where the company has major operations. What if that happens? Then what will be the result on the financial statements of the company? That is a scenario analysis. So every scenario analysis that we conduct is mutually exclusive to each other, and we should make sure we are considering all scenarios. They are exhaustive in them itself. After we have considered all the scenarios that we think can happen, we should assign probabilities to every scenario in order to determine the future prediction. We will make a prediction on that. However, you should keep into mind that there are many limitations of this. For example, let's say COVID. Could any company have predicted COVID? Not many companies would have predicted that. So that is something that is a limitation. We cannot predict everything. So even though we try to be exhaustive, that we cannot be. So our forecast might have certain limitations. However, we should try to establish as many scenarios as possible and try to be as exhaustive as possible and assign probabilities to each scenario to predict the future of the company. And finally, simulation is nothing but doing sensitivity or scenario analysis on computers. We use computers to generate probabilities and predict the future. That is simulation. Multiple scenarios and sensitivity analysis are done, and probabilities are assigned to each future prediction to generate a final prediction for the future. This is how we do forecasting for any company using ratio analysis or any of the methods that we have already described above. So let us take a 5-minute break, and after that we will be discussing everything that we have learned today. Welcome back, everybody. We'll just quickly go through everything that we have done today and then we can leave. So, we started with LOS 21, which is financial analysis techniques. It deals with these following points. We'll just read it out. And then we went to tools and techniques used in financial analysis. What were the tools and techniques? The financial ratios. We went to common sizing of financial statements, regression analysis, and graphical analysis. We learned about ratio analysis. What are the uses of ratio analysis? Excuse me. Sorry. So they help to project future earnings and cash flows. They evaluate a firm's flexibility, assess management's performance. They evaluate the changes in the firm and industry over time, and they compare the firm in the industry with the industry competitors. However, there are certain limitations. There's significant judgment required in making ratio analysis predictions. There's difference in accounting methods, and there are industry standards might not be easily available, and the accounting ratios might give different answers. The interpretations might be inconsistent with each other. Then we learned about common size statements. Common size statements means presenting each line item of a financial statement as a on the basis of a common base. In terms of vertical common size balance sheets, we present the entire every line item in the balance sheet as a percentage of the total asset or total liabilities and equity, whereas in case of a vertical common size income statement, we present every line item as a percentage of the total revenue. However, in case of horizontal common size statements, we present each line item as a percentage of the previous year. Then we went on to use of graphs and regression. Graphs help us to present our data in a much more easier way, which will help people to interpret the values in a much better way. Regression analysis helps you identify relations between different variables, which can lead to forecasting and estimates. It can also facilitate the identification of items or ratios that are moving in contrary to their historical statistical relationships. Then we learned about several types of ratios. We learned about activity ratios, liquidity ratios, solvency ratios, profitability ratios, and valuation ratios. We learned about how valuation ratios help us to determine the operational efficiency, in which there were receivables turnover ratio, which is receivable divided by average revenue divided by average receivables of the company. It gives us how fast are we able to convert the receivables into revenue of the company. Then when we divide it by 365 divided by receivable turnover ratio, it will give us how long do we take to convert the receivables into cash. Similarly, we went to inventory turnover, which is cost of goods sold divided by the average inventory of the company. It will help us to determine the effectiveness of the inventory management of the company. 365 divided by the inventory turnover ratio will give us the time that we take to turn over or to sell the inventory in our possession. Then we went to payables turnover ratio, that is same as purchases divided by average trade payables, and the number of days payables is 365 divided by the payables turnover ratio, which will help us to determine how long do we take to pay the turnovers. Every ratio can be interpreted in both ways, and we need to take a look at everything holistically without making any preconceived notions. Then we went to working capital turnover ratio, which is nothing but the revenue divided by working capital, fixed asset turnover ratio, which is nothing but fixed asset divided by revenue divided by fixed assets, and total asset turnover, which is revenue divided by total assets. All these three ratios tell us how much revenue they are generating per unit of working capital or fixed assets or total assets. Then we went to liquidity ratios, which help us to determine the the ability of the company to meet its short-term obligations. As we move forward, the liquidity ratios become more stringent. Current ratio is current assets by current liabilities. Quick ratios is slightly more liquid current assets, that is cash plus short-term marketable instruments plus receivables divided by current liabilities. It is also called the asset test ratio. And finally, the cash ratio, which is the cash and short-term marketable instruments, which is current liabilities. This is the most stringent liquidity ratio. Then we learned about two new liquidity ratios, which was defense interval ratio and cash conversion cycle. Defense liquidity ratio tells us the money that we have, the short-term the extremely liquid assets that we have to meet the daily expenditure of the company. This ratio helps us to determine how long the company can run its business without earning a single rupee in fresh cash inflow. Finally, we learned about cash conversion cycle. It tells the time taken to convert cash paid into cash receipt, that is the days of inventory held plus days of sales outstanding minus number of days of payables. Then we learned about solvency ratios, which is the ability of the company to meet long-term debt obligations. This is a debt to asset ratio. The debt in comparison to total asset, that is the percentage of debt as compared to the total assets of the company. Debt to capital, that removes certain assets and liabilities from the total assets, that is total debt divided by total debt plus total shareholders equity. So any other non-current assets, non-current liabilities, or other non-current or other current liabilities are removed. Then we learned about financial leverage ratios, which is the average total assets divided by average total equity. We learned about interest coverage ratio, that is the ability of the company to earn earnings to meet its interest obligations. So that is EBIT divided by interest payments, the earnings of the company before interest and taxes, and how much earnings the company is earning in comparison to the interest. We want it to be multiple times the interest payment. Similarly, we can also do fixed charge coverage ratio, that is the earnings of the company before its fixed charges to meet its all fixed charges. Fixed charges include both interest payments and lease payments. Then we learned about profitability ratios. The various profitability ratios we learned about were gross profit margin, gross profit by revenue; operating profit margin, nothing but the operating profit by revenue; pre-tax margin, which is the profit before tax divided by revenue; net profit margin versus the profit after tax divided by revenue. Then we learned about the various profitability ratios based on assets. So that is operating return on asset, that is operating profit divided by average total asset; the return on total asset, that is net income divided by average total asset. We learned about the return on total capital, that is EBIT divided by average total capital. Then we learn about return on equity, that is net income divided by average total equity of the company. And finally we learned about return on common equity, which is nothing but the return on common equity, that is net income minus preferred dividends divided by average common equity of the company. Then we learned about how we can break return on equity into a 3-point dew-point analysis or 5-way dew-point analysis. The 3-way dew-point analysis broke down return on equity into net profit margin, asset turnover, and leverage ratio, whereas the 5-point dew-point analysis broke it down into tax burden, interest burden, EBIT margin, asset turnover, and financial leverage. I hope everybody has understood those points. Then we learned about the various things that we can learn about equity analysis. So there were certain things that we need to keep into account, such as BEPS, DEPS, cash flow per share, EBIT per share, EBITDA per share. So when we went to valuation ratios, we learned about how the market value, how we are valuing the company in market. So for example, we heard about Amazon and how Amazon was trading at $89 per equity share, and its PE ratio was 82. So that means that Amazon was earning $1 of earnings for every rupee of so that means that the Amazon is valued at 82 times its earnings. So PE ratio means how much times the investor in common stock pays per dollar of earnings. Then we learned about price to cash flow. This is relevant because the earnings might be distorted. What if the company had negative earnings? That then we use the price to sales ratios. And finally, price to book value. This is more relevant for financial companies. That is something we'll discuss later. Dividend to sustainable growth. What we learned was the company can declare dividends. So dividend declared by net income is the dividend payout ratio. 1 minus dividend payout ratio is the retained earnings ratio. That is also mentioned as B in our PPT or slide. So now retained earnings is the money that the company is reinvesting into its company, and the retained earnings multiplied by return on equity will give us the growth rate or the sustainable growth rate of the company. We learned about certain industry specific financial ratios and how certain industries might have certain ratios which are more relevant to them, such as service companies might have revenue per employee, which is more important to them. Then we learned about credit analysis, how there are several ratios which companies can use and how analysts can use to analyze the credibility of the company, or whether the company can repay its long-term credit obligations. Then we learned about segment reporting and how if the company has any segment which represents more than 10% of its revenue, profits, or assets, then it needs to be reported separately. Thus, if all the reported segments do not constitute 75% of the total assets or total revenue or total profit, then we need to keep on adding additional segments till we form at least 75% of total assets, total revenue, or total profits. These were the several items that need to be separately reported for every segment of the company. Then we learned about several segment ratios, which were segment margin ratio, segment turnover ratio, segment return on asset, and segment debt ratio. And finally, we learned about forecasting techniques, in which we learned about sensitivity analysis, scenario analysis, and simulation. That is all for today, guys. If you like the video and you understand CFA level 1, it is helping you, please watch our videos, like, share, and subscribe to our channel. and tell your friends about it so that they also can score good marks in their CFA level 1. Thank you everybody. That is it for today and I will be taking my leave.